Hey guys, James here with Waterford Business Solutions, and today I wanted to walk y'all through creating an amortization schedule for any loans that you have. Whenever we get a loan, we always want to have a amortization schedule on file to help us calculate where our payments are going from interest to principal so that we can correctly record in our books the remaining principal on that liability on a monthly basis and expense the interest. All interest is tax deductible, so we do want to expense that on your profit and loss. And more specifically, not just expense that interest on your profit and loss, but also make sure that we keep your principal balance on your balance sheet for that liability equal. Now today I'm going to specifically be talking about vehicles because most of my clients end up using having to buy vehicles on a regular basis for service trucks or vehicles or vans or whatever. So we need to know how to go about doing that. So we're going to go through two different examples here. One, just a normal car loan, and another one where you may put down or pay a little bit extra. So go ahead and join me today and we are going to dive into all of this. Okay guys, so I have gone ahead and pulled up a auto loan calculator, and over here I have a 553, which is what should come almost any time you buy a vehicle. Anytime you buy a vehicle, you should always get something like this, and we want to have this exact stuff every single time, whether it's a new vehicle or a used vehicle. We should go ahead and have all of these details. Yes, it is going to tell us the make and model and year of the vehicle that you're buying. That's all important so that we can put it in for depreciation. But that's a different story. We're not talking about depreciation today. We're talking about amortization of interest in a loan. So whenever we look at these statements and everything, we're always going to have a few different things. First and foremost, we're going to have our APR, which is going to tell us the APR, the percentage rate that we're going to pay. The finance charge, how much you're going to pay in financing fees. The financed amount, so how much you're financing. The total amount you're going to pay, and then the total sales price of everything. So total cost of what you are buying is going to be here, and then any down payment will be recorded here. And then we're going to also have number of payments, how much your payment should be, and when your payments begin. So we've got all of that information, all of which we're going to need to create this amortization schedule. So I'm going to use this to create us an amortization schedule. Now one thing to keep in mind here, and this is slightly off topic but I still like to make it known, this is a very high interest rate. First and foremost, this is a used vehicle, and used vehicles you tend to have a higher interest rate. That's not per se a bad thing, but just bear that in mind. But currently, and I'm talking like into 2020, beginning of 2021, even in used vehicles, we shouldn't be looking at much above 6-7% even for bad credit. Now this particular car or application, this is just something that I found online, and you can see that it's test buyer, so they might have just put in a bad interest rate on this. So we're going to go ahead and hop into everything here on this auto loan calculator. So the first thing it's going to say is how much are you looking to borrow? Well, we're going to pull that right here from the amount financed. That is what you're borrowing, is this amount financed, 9664. So we're going to go ahead and pop that in, 9664. Then we want to know how long are you paying for this? So number of payments right there, 36 months. So we're going to pop that in for how long at 36 months. Perfect. Then we want to know if it's new or used. That really doesn't affect the amortization, but it is something nice to know. And then we want our APR, or our interest rate. That's going to be that 15.36%. So I'm going to pop that in there. And what we should get here is we should now get total principal paid should match what we borrowed. Total interest paid should match or be very close to this number right here, $2,457, which it is. It's a few cents higher because this takes it all the way down to the cents. So we are looking at about 44 cents higher, but 44 cents isn't going to kill us. And then our payment amount should match or be very, very close. And again, we're at $337 instead of $336.71. So we are 29 cents higher, but that's just because this is going to round on us. This is not going to be the exact thing. We're still going to need to compare to statements that you receive from the loan company, at least at the end of the year. But we do want to go ahead and get this. Now, the first thing we want to do is we want to change this start date to whatever the date is listed here, monthly beginning on January 12th of 2019. The reason we want to do that is that's going to make sure that our rates, everything, payments, principal, everything like that, the payment date matches up to when it should have been paid. So you're going to notice here payment of $337 every single time, and then you're going to have in this principal column how much of your payment is paying principal and how much is paying interest. As you'll notice, slowly over time, this interest decreases. Every single month it decreases, and your principal payment increases. That's why we need this amortization table, because by the time we get to the end of everything, you're paying very little in interest and mostly just paying on the principal, because that is how the loans work, is as you start, you pay more in interest, less in principal, and then it just switches as you go further in the loan. We want to, every single time we make a payment in our books for $337, we want to make sure that we apply $213 of it to the loan or the liability on your balance sheet and $124 to interest. The next month, instead of $213,124, we would do $216,121, then $219,118, so on and so forth. At the end of the year, after December, once we're kind of reconciling everything out and getting prepared for taxes, we want to confirm this should be the balance according to our books, but we want to confirm that this is the balance according to the bank or the loan company. If this is off, we want to make sure at the end of the year, as of December, that this balance matches, or what is in our books matches what the bank says. Otherwise, it's going to throw us off, and our numbers aren't going to be correct, and we're either going to pay more in interest or less in interest than we actually did. So it's very important to go through and do all of that. Now, this is for a normal auto loan, assuming that you're not going to pay anything extra. Some people will pay extra on an auto loan and pay it down early, and that's great, that's fine. But when we are looking at an auto loan, and the calculator that I like to use is Bankrate, and literally you can just Google Bankrate auto loan calculator, put in all these numbers that I just showed you, and then get this amortization and then print the schedule so that you can either keep this digitally or keep it in a file folder with you until that loan is paid off. But it doesn't give you the ability to record extra payments. So if you're someone and you know that you are going to make extra payments, we're going to use a mortgage calculator. And I know this sounds very weird, and I understand, but we still want to use this. We're just going to, instead of looking at this as a mortgage, look at it as a normal loan. And we're going to put everything in exactly as we did. What was our mortgage amount or our loan amount? Well, our loan amount was $9,664. So we're going to go ahead, pop over here, $9,664, and pop that in. Then we want to know our loan term, either in years or months. Well, auto loans are always given in months because they're short-term loans. So either convert the months to years, and that's 3 years, or just put in the months down here, and it will convert the years up here. Then we're going to go ahead and put in our interest rate. Interest rate again is that 15.36%, and we're going to calculate there. Now this one is going to get us more accurate. Generally a mortgage calculator will be more accurate than a auto loan calculator. Why, I don't know. That's just how Bankrate works. But if we look at this, it's coming out to $336.71, which is the exact same amount in payment. So we have no discrepancy there, unlike the 29-cent discrepancy that we had on the auto loan. If we look at this amortization schedule again, we're going to want to change our date here to the beginning date of the loan. Pop all of that in, and it is going to give us a better breakdown of our principal versus interest because we're not rounding off. We are getting the cents. Now this will get you, when we get down to December, this balance should match up exactly. It may not. Still review it, double check it, because we never know how the bank is comparing. This is just giving us an idea of what the bank is doing. But let's say you want to go ahead and add extra payments. What you don't have, or what you have here, what you don't have on a typical loan or auto loan, is going to be this add extra payments. And let's say we want to pay $350 a month. So we're going to go ahead and increase our payment to that $350. So that extra payment will be $1,329. We'll pop that in there and apply this extra payment. And then it's going to go ahead and give us this $350 payment. You'll notice that the interest payment doesn't change at all, but your principal has gone up by $13.29, which means you're paying that $1,329 directly against principal. This means ultimately you will pay less in interest instead of that original, if we come back over here and look, that original $24.57 in interest. Now you're only going to pay $23. So you're going to save over $100 in interest by paying that extra $13. But that's also going to change your interest payment. So after the first month, your interest payments every single month after that are less. And ultimately, you will be paying off a month early, and your final month will have a lower amount due. So that's very important to remember there, just because you're paying it off quicker. So if you're someone that you just want a nice, easy, round number for you to pay at that $350 a month instead of the $336, make sure you add these extra payments in, because it will affect how much you are paying in interest over the life of the loan. So guys, that is how we go ahead and use these amortization calculators. I know I talked about vehicle loans, but these can be used on equipment loans, tool loans, property loans, a mortgage, because I used a mortgage here. And anytime you get a loan, vehicles, you're always going to get something that looks like this, but almost every loan, even equipment, is going to have information exactly like this. A mortgage isn't going to show you in this direct scale, but it's still going to be very, very similar, where you're able to find your APR and the amount financed along with your origination date and the term of that payment, because that's what we're looking for to create these schedules. As always, guys, please utilize this, and I hope it helps you out. If you have any questions, please feel free to email us, call us, or text us at info@waterfordbusiness.com, or give us a call at 864-351-0852. Have a wonderful day, guys.